Let's get trading started officially for the month of August. Equity futures going into that opening bell. Negative here by 1/3% on the S&P and the Nasdaq. Down about 0.4%. 5 months of gains on the S&P 500. Longest monthly winning streak going back to 2021. Can we continue the winning streak? There's the opening bell. Switch on the board and get to the bond market. Your 10-year yield shaping up as follows. Yields up and away this morning. Higher by 5 basis points. Back through 4%. 4.0129% on a 10-year yield. A little bit later this morning, 30 minutes away. ISM manufacturing and job openings in America. In the FX market, a bit of dollar strength, a bit more against the yen and sterling against the euro. We're negative by 0.2%, 109.76. It's a break of 110 in the last couple of days. In the commodity market, we pulled back on crude, $81 on WTI. We're negative there by 0.7%. Crude over the last month through July, best month of gains, Lisa was telling me a little bit early this morning, since early last year. So decent month of gains so far for crude, and let's see if it continues into August as well. One stock to watch at the opening bell, Caterpillar, shaking off slowdown concerns and posting better than expected Q2 earnings. The CEO saying this: our results reflect continued healthy demand as we achieve double-digit top-line growth. Abby has more. Hey, Abby.
Hey, John, and this is really a very impressive quarter, and a tell, to your point there, potentially on the global economy, that this recession that we've all been waiting for, well, it's really not showing up in these results. They beat in a big way. Specifically, they put up $5.67 in adjusted profit on $16.5 billion of revenue. Not small numbers. That represents a 5.7% and a 25% beat. That's the degree of strength that they are seeing. So very resilient demand for the company's iconic yellow machinery across all of the business segments. Double-digit revenue growth, machinery growing by 16%. Compare that to your Microsofts and a lot of the other big tech companies. Caterpillar is blowing them right out of the water. So this is one of the companies, many companies I should say, that has successfully handed along higher prices. But on big ticket items, the stock, John, right now having its best day since June 7th on the year, up more than 10%. Caterpillar is certainly a piece of the breadth that we're starting to see for the market rally.
Let's see if we see more of it for longer. Up 3% this morning. Abby, thanks for that. Some mixed results elsewhere from Big Pharma. Merck raising its annual sales forecast. Pfizer trimming $1 billion off their own outlook, but remaining optimistic, saying this: despite a few revenue challenges, we believe we're positioned for accelerated growth in the second half of 2023. Simone Foxman has more. Hey, Simone.
Yeah, John, Pfizer cutting about $1 billion off of its full-year sales forecast, but keeping its full-year guidance on its COVID shot and pill at $21.5 billion. However, it says that those drugs are responsible for a second quarter revenue that declined by 54% from a year ago quarter. Ex-COVID sales growth, that's the big focus of investors, because they revised their estimates down to 6 to 8% for the year versus 7 to 9% as it was earlier. Where does the growth come from now that the pandemic is past? That's a big question. Merck having a bit of an opposite problem. It actually saw better than expected results from its two top drugs. Cancer drug Keytruda, second quarter sales up 19% from the previous year. HPV shot Gardasil, second quarter up 47% year on year, especially because of increased demand in China. But investors really trying to figure out, where does the growth come next? Both of those have patents that expire in 2028. So looking to the end part of this decade, John.
Simone, thank you. Pfizer pretty much unchanged. Merck a little bit higher, up by 1.7%. JP Morgan reiterating its bullish view on Merck following its results. The analyst saying, we continue to view the company as having one of the cleanest paths to upside to both near-term and longer-term numbers in the group, estimating double-digit EPS growth through the late 2020s. And while shares have re-rated over the past year, we continue to see the stock as attractive. We remain overweight. Merck is up by close to 2%. Getting back to earnings, shares of Norwegian Cruise Lines are sharply lower after delivering weaker than expected Q3 guidance. The CEO saying, quote, we are focused on sustaining this momentum by capitalizing on robust demand and ultimately charting a path to reducing leverage. Katie has the story. Hey, Katie.
Hey, John. Yeah, Norwegian shares really plunging in the wake of that report, currently off by about 10% or so. They were lower by as much as 16% pre-market. And to get into the numbers here, Norwegian sees adjusted third quarter EPS at 70 cents. Analysts were looking for closer to 79 cents. And that's dragging down the stock, even though the company beat on its earnings, and it lifted its full-year EPS outlook. And actually, Norwegian is on track to sail more customers this year than it did pre-pandemic in 2019. You wouldn't know that by looking at the shares necessarily. It's dragging down its peers as well. Think Carnival and Royal Caribbean this morning. And it's probably because, in part, the bar is really high for these names. If you look at an S&P index of hotels, resorts, and cruises, currently up about 45% this year. That is double the S&P 500's performance.
3 of the top 10 stocks so far this year before today were cruise lines, which is just kind of nuts. Katie, thank you. It's been that kind of year so far. Let's wrap things up with Uber, out with earnings this morning, reporting its first ever operating profit, fueled by record demand for rides and deliveries. The CEO, Dara Khosrowshahi, saying these milestones were achieved through a combination of disciplined execution, record audience, strong engagement. We are well positioned to sustain long incremental profit generation. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. The stock is down 5.5%, completely reversing direction from pre-market trading. Broadly, the sell side sees this as a solid quarter. Net income of $394 million was a surprise. Analysts were expecting a loss of $49.2 million. Record ridership volumes in the quarter, but you have to realize that a big factor behind net income was unrealized gain in equity investments, which was a large contributor. It's the first ever profit on a GAAP basis, $326 million, free cash flow $1.14 billion. They're forecasting gross bookings of $34 to $35 billion in the third quarter, ahead of expectations. Adjusted EBIT will be $975 million to $1 billion, ahead of expectations. We also got confirmation that CFO Nelson Chai will step down effective January 5th. That confirms the Bloomberg reporting from early July. The search for his successor is underway. Number of trips, gross booking, active drivers all hit record levels in the quarter just gone, which tells you both about the demand but also the supply picture. The freight unit continues to see losses on an adjusted EBITDA basis. Finally, John, headlines from the call. Uber CEO Dara Khosrowshahi addressing the idea of competition with Lyft and saying that for the time being this is going to remain a two-player market for, quote, some time, acknowledging also that Lyft is being more competitive on a pricing basis. Right now, a lot of focus on continued growth in both grocery and delivery for Uber Eats.
Lyft also down this morning. The earnings about a week away, a week today. Ed, what do you learn from this release from Uber about Lyft next week?
Yeah, it's interesting that they acknowledge the effectiveness of what Lyft has done with its new CEO in response on pricing. Insurance costs have been a really big factor for Lyft in the prior 2 quarters. Going to be asking Dara Khosrowshahi about if they also are worried about insurance costs. But if it's going to be a two-player market for some time, that signals to me that we've got to continue looking at pricing. What are you going to do to stay competitive on the demand side and the ridership side?
Ed, thank you, mate. Lyft is down by 4%, down by 3.8% right now. Uber's negative by close to 5 percentage points. Lyft numbers come next week. Coming up on Thursday, you know the 2 big names we're looking for, Apple and Amazon. City Stuart Kaiser making a case for sticking with big tech this earnings season.
Earnings growth is still relatively scarce. If you look at the drivers of performance this year, EPS momentum or positive revisions to consensus numbers have been a key driver of returns of the leadership of the market, and we think that continues. I think the core view remains tech and growth, because I think growth is still scarce both in the U.S. and globally, and it's large cap U.S. equities which have that growth. So we're not ready to pull the cord on that one quite yet.
Let's continue that conversation. We can do that with JP Morgan's Monica DeCenso. Monica recently upgrading her outlook on the equity market. Monica, let's start with that outlook. What's it driven by and what's the number now?
It's driven by, quite frankly, fundamentals for the U.S. economy that never turned out to be as bad as people thought when they came into the year. And so we were bullish equities at the beginning of the year, thought we'd get to 4,600 by year end. Obviously, we got there a bit faster than expected. And so when we looked at our outlook again and re-underwrote our thesis, we said, hey, this is a market that is stronger than we thought. And it looks like, quite frankly, the U.S. consumer is stronger than we thought. And when you add that up with reasonable valuations, broadly speaking, you can see a scenario where equities can still return 6-7% over the next 12 months.
So the numbers I'm looking at, 4,800 to 4,900, perhaps by the middle of next year. Monica, when you think about the opportunities, do they lie at the market cap index, S&P 500, or elsewhere?
Yeah, I do think this is an interesting setup for equities because you, for the first time in many years, have the opportunity to look beyond big tech. By the way, I still think tech looks fine. You still want that growth in your portfolio. But for too long, people relied probably too much on a few sectors. And now we actually look at this rally and it was very disproportionate. And it's time to look under the hood of the S&P and figure out where is their value? Where are their secular opportunities? I think you saw from Caterpillar this morning, industrials could be a place that look a little more interesting. And in fact, when you peel out those large cap tech names, you find cheaper valuations versus historical levels. So I do think it's time to return to fundamentals, if you will, look at valuations and look across sectors rather than being heavily leveraged to just one or two parts of the market.
Well, let's talk more about sectors. Outperformance in July, the banks up 10%. Let's talk about size. Small caps up 6% on the Russell versus the S&P up something like 3%. Monica, can we start with the banks? Do you see reason for that bank rally to continue?
I think you saw that rally, obviously, coming out of what happened with the regional bank crisis earlier this year. You saw everyone just sell down bank exposure broadly. And at the end of the day, there still are opportunities. You want to be selective with the regionals because there are some that have balance sheets maybe that are less strong or have more commercial real estate exposure. But broadly speaking, when I look at some of the larger banks, they still look fundamentally fairly strong. And that's both the equity side, and we also look at things like bank preferreds, which sold off very meaningfully and can be a really interesting way to get yield within a balanced portfolio today.
I noticed that you've dialed back your view on Europe, just relatively speaking, to the United States. Monica, can you walk us through that?
Yep. It's actually a quite similar story to the U.S. We called for Europe outperformance at the beginning of the year. That happened, especially when you think about in dollar terms, helped by good fundamentals as well as obviously a strengthening euro. So today when we look at it, just think it looks more balanced. Like the U.S., I think there are pockets of opportunity. I look at the energy sector, for example. You still have many names that are trading at deep discounts to their U.S. counterparts. And so I think it's just about being selective in sectors and stocks rather than owning the broad market as your only way to get market exposure in Europe.
So, Monica, two things. You picked out energy potentially out of Europe, industrials potentially out of the United States. How much exposure cyclically are you taking at a time when some people think eventually this recession is going to bite and it's a mistake to extrapolate out the recent resilience through next year?
There's no doubt that after this equity rally we've seen, we don't want to be too levered to any one part of the market. I think when I look at what the market is giving us today, and that's how I think about where to add exposure, I see a disproportionate rally, right? Some sectors driving a lot of the outperformance. I see high rates and I see low volatility. And so I look at those three parts to think about cobbling together interesting returns over the next year. I think equities will give you positive returns, but do not ignore fixed income and the fact that you can get very similar returns with maybe different risk, thinking about parts of the fixed income world. And so I like to have that balance. And over the next 6 months, we may very well see volatility. You may get chances to lean in a little more heavily broadly to equities. But I think my message here is don't be scared of this rally, just be a little more selective.
Well, let's wrap it up. Let's just finish in fixed income. How selective are you being? Where in fixed income? What pockets do you like? What don't you like?
Yeah, very clear in public markets, you're not getting paid in high yield what I would want to get paid to take that risk. So you can be more conservative. I mean, we work with a lot of U.S. investors, munis, investment grade on the public side. You're still making that mid-single digit return. That makes sense. I mentioned bank preferreds, again, selectively. You can get even better returns tax equivalent. And then, of course, on the private side, there are opportunities in private credit, but we know lending is going to be tougher, and you're going to see some credit constraints moving into the back half of the year and next year. So again, it's about being selective. Although in private credit, you can get those double-digit returns by looking at the right kind of investments. And we just focus on making sure you're looking at companies that have reasonable leverage and a good runway for growth.
Monica, thanks for the update. As always, Monica DeSenso on the latest there from JP Morgan. The outlook pretty decent and hoping for more of the same through next year. Right to be constructive so far, and that's hard to push back against given the gains we've had year to date. To start things off in August, about 13 minutes into August and this session, we are negative by 0.2% on the S&P 500. On the NASDAQ, we're negative by 0.44%. Coming up next, Governor DeSantis outlining his economic plan.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class.
What did that remind you of? That conversation up next.
it's time for the American people to take back their future. We're going to take it back. We have become more dependent on foreign countries than ever before. Ladies and gentlemen, it's time to declare our economic independence once again.
It is time to declare our economic independence once again. Former President Donald Trump running the base back in 2016. 7 years later, Governor DeSantis unveiling his very own Declaration of Economic Independence.
We are today declaring our economic independence from the failed elites and policies that have harmed this nation's middle class. We will declare our economic independence from the failed elites that have orchestrated American decline, from the reckless federal spending that has inflated prices and plunged this nation to the brink of bankruptcy. We will declare our economic independence from the Chinese Communist Party.
Governor DeSantis challenging trade relations with China and taking aim at the Federal Reserve.
We need to rein in the Federal Reserve. It is not designed or supposed to be an economic central planner. It is not supposed to be indulging in social justice or social engineering. It's got one job: maintain stable prices. And it has departed from that with what it's done over the last many years.
Joining us now down in Washington is Bloomberg's Anne-Marie. Anne-Marie, that didn't go unnoticed by the former president, did it? Declaration of Economic Independence.
No, it certainly didn't, but clearly the Florida government is taking a playbook out of another Florida man, Trump. If it worked for him in 2016, I guess the DeSantis camp thinks, can it work for Governor Ron DeSantis for 2024? But what we do see, Jonathan, from the DeSantis camp, which Trump is just crushing in the polls really across the entire Republican stage, is we see a broader pivot to talk about more than just going after quote-unquote woke corporations. He's talking about everything from China, from taxes, energy independence, student loan debt relief. So this is a really broad economic plan, and it shows that DeSantis is trying to look beyond just his playbook in Florida and what works for Florida maybe can work for the rest of America, and really try to reach to a broader spectrum of Americas. So what you see here in a lot of these policies is the typical conservative Republican policies when it comes to the economy, but also when he talks about China and a tough stance and a harsher stance on China, that is really invoking a lot of populism that we have seen over the past 5 to 10 years from the Republican Party.
When he says we win, they lose, who is we and who are they?
That's a great question. You know, Jonathan, your production team and I were debating this. When Ron DeSantis says we win, they lose, he's really going after everyone. Democrats, bureaucrats, the elite, because he says that we need to get policies that help working class families, and of course, Beijing.
Anne-Marie, on the latest down in Washington. Looking forward to Balance of Power a little bit later. Catch up on that program at 5 p.m. Eastern Time. Let's get you up to speed on some of the economic data out moments ago. Katie Lyons has more. Hey, Katie.
Hey, John, we got the final July read on the U.S. S&P Global Manufacturing PMI. It matched the prior read at 49. So for a third month in a row, manufacturing remains in contraction territory, though that contraction is happening at a slower pace. Remember, the pace, the June read was 46.3. So this is an improvement. Still, though, new export orders fell for the 14-month running. Firms also reported, interestingly, a renewed rise in material costs, raw material costs, input prices faced by manufacturers increasing for the first time in 3 months. So an interesting inflationary read there. But on the employment read, especially, John, as we look forward to the data later this morning and throughout the week, culminating in the jobs report on Friday, companies did expand employment at a faster rate with greater confidence in the outlook going forward. So we remain in contraction in the manufacturing sector, John, but they maybe see a brighter future, and that would read through to the labor market in theory.
Katie, thank you. That's the final read of the S&P Global Manufacturing PMI. We get the ISM at the top of the hour. The ISM manufacturing number, looking for that to come in at 46.9. 46.9. That is the number in our survey right now. Looking forward beyond that, jolts as well coming up in about 8 minutes time. Beyond that, go to payrolls. Katie mentioned payrolls. The estimate at the moment in our survey, still 200,000 for the headline jobs growth number for payrolls. For unemployment, about 3.6%. Let's get you some sector price action. We can do that with Abby.
Hey, John. Well, we do have a small decline for the S&P 500. Not surprisingly, most sectors are lower. One that is is higher. Industrials up 0.3%, helped out by Caterpillar. It's interesting that we're having this manufacturing weakness, given the strength for at least one of the industrial companies, Caterpillar. Most of the other sectors, though, you can see down. Discretionary and communication services, two of those mega cap tech sectors, well, they are both down about 0.5% or so to start out the month of August. Now, going back to July, you were mentioning earlier, China tech up 20%, its best month since November of last year. But today, a little bit of a cooling here. The Golden Dragon China Index down 1.4%, and lots of the big players taking a break to probably a consolidation of those big games, John.
Abby, a little bit lower this morning. Abby, thank you. We're down by, let's call it 0.2% on the S&P. Your trading diary is up next. The outperformance last month in July came from the Russell, up 6%. This morning it's where the underperformance comes from. The Russell is negative by 0.75%. The S&P 500 a little lighter. We're down here by 0.2%. That's the price action. Here's the trading diary. Coming up, the JOLTS report and ISM manufacturing numbers at the top of the hour. Qualcomm earnings on Wednesday, followed by Apple and Amazon results on Thursday. Plus we get a Bank of England rate decision on Thursday as well. Another round of jobless claims too, and durable goods orders. And finally on Friday, the payrolls report. The payrolls report, and what I think is the best lineup on payrolls day in America anywhere on the planet. Rick Reeder of BlackRock, Anastasia Amoroso of iCapital, Mike Collins of PGIM, Mohammed Al-Aaron of Queen's College Cambridge, and so much more. All of that coming up on Friday. Just a few more days to go. From New York City, that does it for me. Thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, August 1st. Here are the top market stories that we're following for you. It's the catch-up trade. Wall Street has a new 2023 bullish target of 4,900 for the S&P, while hedge funds start to reposition, hiring on all cylinders. We're going to have an exclusive interview with Paul Taubman, CEO of PJT Partners, an investment bank with a record year in hiring. And the data drop. You got Joel's ISM breaking right now. We have instant analysis with Tim Fiore, chair of the ISM Manufacturing Business Survey Committee. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, let's get to it.
The data look pretty much in line with expectations. The ISM, maybe we're hitting a bottom. The JOLTS number comes in a little shy. Mike McKee joins us as ever to break down the numbers. Mike, what do you see in front of you?
Well, Jay Powell, if you're paying attention, the JOLTS numbers come in a little bit better than anticipated. They're falling, and they're falling more than the economist survey suggested, 9,582,000, down from 9,824. The forecast was for 9,600,000. So that is a little bit better improvement in terms of JOLTS. The ISM number comes in at 46.4, up from last month's 46. Not as good as the 46.9 people thought. Prices paid at 42.6. We see a little bit of a turnaround. So that's something to ask Tim about. Why are we seeing prices paid go up? The obvious vector has been down, and employment at 44.1 is significantly down from 48.1, which sets up an interesting question about what we're going to see on Friday. And new orders for ISM, 47.3 from 45.6. So we do see maybe you're right, Guy, a bottoming out here for the numbers, but in terms of the ISM, but certainly not anything that screams good news at this point. Back to JOLTS for just a second. Hires decreased as well as the number of job openings. Hires fall by 326,000, and the hiring rate a little changed at 3.8%, and the quit rate is at 2.4%. That comes down from 2.6%. So a little bit more good news for the Fed, which we'll see this as the labor market loosening up a little bit.
Mike, great breakdown. Really appreciate it. And the market, where you're just seeing a teeny bit of movement, is in the front end there. We're now back to zero on the 2-year yields. Mike, thanks a lot. Let's get instant analysis with Tim Fiore. He is the chair of the ISM Manufacturing Business Survey. Tim, ISM Manufacturing contracting for the 9th straight month. Categorize that for us.
So for the last couple of months, we've been stating that there's very little evidence of any increase in demand, and that's for sure. And we said for the last couple of months that the factories were going to have to take some action in terms of headcount because they're going to have to adjust their revenues down to coincide with the lack of backlog and the lack of demand. So in the month of July, we actually saw that. We saw production come down, not as much as in June, but it still came down. And more importantly, we saw employment come down pretty significantly compared to where we've been. So it validates the hypothesis that factories are now adjusting for a new half 2 level of output, and they're adjusting their head count because they can't afford to remain profitable and keep all those heads. The positive thing is that on the demand side, we did see a slowing here of the new order level, which means we're not growing, but we're not contracting as fast.
Yep.
The new export market is not going to be a help at all. And the other thing
Tim,
is this. Oh, go ahead.
Is this the bottom? This is the key question that everybody's trying to get to. Is manufacturing bottoming out here?
Well, I think we've got a couple of months here, 46. We've had 3 or 4 months in the 46 range. The sub-indexes that make up the PMI are shifting. In the month of July, they shifted, I think, in a positive direction. So we could very well be in the trough. It's very possible, and we would have been in that trough for probably a month, maybe 2 months. This would be maybe, July would have been maybe the 3rd month of the trough. But we're hanging around 46. Like I said, the new order level is starting to come back. The backlog is starting to climb now above 40. We're not expanding by any means, but we're not contracting as fast as we have been. So it looks like factories have kind of right-sized. There may still be some layoff activity and trading down occurring through the rest of the summer. We did have a significant amount of panelist comments indicating that freezes and attriting and layoffs were a big part of the playbook to get the head count down. But, we may be in a period here as we close in the summer here to readjust to a new output level for Q4 and, trying to make sure that we remain profitable through the rest of the year.
What did you make of the prices paid? I
like
missed
it.
estimates, but you liked it. Okay.
I like it because, we're not contracting as fast as we were in the month of June, but we're still contracting pretty strongly at 40 and some change. So it means that overall our input costs are dropping from a material standpoint, continue to drop. We did report in this month that we had a lot of stuff going up and down, which would indicate that maybe we're achieving a sustainability level for the future. When you have stuff being reported up and stuff being reported down, you're obviously in a transition period. So we had some of that in the steel area, we had some of that in plastics. So that again would support the fact that maybe we are in a trough here and that things are kind of resetting now for the growth.
Tim, I'm listening to a number of analyst calls from the big manufacturers, both in Europe and in the United States, and they're talking about the fact that maybe the benefits of the supply chain ease that we've seen are now over, i.e. we're starting to see things maybe bottoming out on that front as well. Are we through that easing process now? Does that tailwind that we had now start to dissipate?
Well, we're still very accommodative from a supplier delivery standpoint. Not as much in the month of July as we were in June, but marginally so. We did see manufacturing inventories, although they still contracted, they didn't contract as fast. So I think the input side supports the fact that, okay, maybe we're at a leveling here that works for everybody. I mean, we don't have a single number here that's over 50 in all 10 sub-indexes. Mm-hmm. So we're really talking about 10 sub-indexes all contracting. But they're not contracting really as fast as they were in May and June, which I think is a positive signal for probably the fall. I mean, I don't think that August is never a really big manufacturing month. We do have seasonal factors that'll help on that. But, maybe we're going to see some growth here, some 50-plus numbers start to show up in the October timeframe.
Okay, we'll hold you to that. Tim, I want to get your take on the employment number here for a second. Are there actual layoffs happening, or is it just not hiring anymore / labor hoarding?
So, I track attrition actions, freezes, and layoffs. And in the month of June, the layoff piece of those three stool legs was stronger than it had been in the prior 4 or 5 months. In the month of July, they're all about equal again. But I will say that I had a lot more comments indicating that they were taking those kind of actions, either attriting down to lower levels, which seemed to be the biggest one, freezing hiring, and layoffs. So, it's all, at this point, companies still have to right-size their headcount for what they perceive to be the next 6 to 9 months. And I think that activity started in May, continued in June, and really started to accelerate much more in July. And I like that employment number. We needed to see that number come down. It came down. I think that's a positive step. Production number didn't come down as much as the month of June. I think that's a positive step too. Indicates that revenue will be pretty sturdy for the panelist companies. So, and on the input side, things are easing, maybe not as much as they were in the June timeframe, but they're still very accommodative. So we're positioned for, new orders, and the fact that new orders didn't contract as fast, the fact that backlog didn't collapse as fast as it did in June, I think are all positive signs for the future.
Hey, Tim, we appreciate it. We'll hold you to this October. We'll see you the next couple months. Tim Fiore, I really appreciate it. Instant analysis with chair of the ISM Manufacturing Business Survey Committee. Looking at the equity market, this was not a mover, which was surprising. You really felt it on the front end with 2-year yields kind of heading flat after the number came across. Now they're up by about 2 basis points. Well, coming up, we're going to get to our question of the day. What do you do with this market? Should you be chasing it? Are people throwing in the towel? Mark Connors, a 3IQ head of research, will be joining us next. This is Bloomberg.
Today, PJT Partners CEO, founder, and chairman Paul Taubman sits down with Bloomberg's Shonali Bassick for an exclusive deep dive into the state of business. Tune in live at 10:45 a.m. Eastern, only on Bloomberg, your global business authority.
If there is a bit of a downturn, it's a quick recovery. So actually, even the recovery in the equity market would be so quick that you're probably not going to be able to time the bottom perfectly.
Yep.
So really, you should be taking a kind of a 6-12-month outlook and saying, where do you think equities are going to go over that time period? And from that perspective, it should really be higher.
That was Seema Shah, Chief Strategist at Principal Asset Management, speaking to us yesterday. And that brings us to the question of the day on the heels of some reporting from some of the investment banks about what hedge funds are doing and degrossing, selling some shorts, selling some longs, kind of de-risking a little bit. What do you do with the market? Should you chase the market? Strategists are. Should you, if you're an investor, want to bring in Mark Connors, Head of Research at 3IQ. Mark, you also in your career have tracked what hedge funds are doing. Yeah. What do you think what would you think if you're a hedge fund right now? Like, should you chase the market?
I think they're chasing vacation. It's been a really tough year. A lot of these hedge funds are either side of flat coming into the second half. And that goes for macro as well as long short. I mean, long short, as we know, was narrow. It was AI driven, so the fundamental research they do wasn't really that useful. It was all just sort of all on black as far as AI. And it was expansion. It wasn't earnings driven. So all that brain power wasn't really useful in first half. So not a lot of gains. On positioning side, I think the biggest one is, and it's a bit of a consensus call, is short in the 10-year. And as you see that, I think today, where are we in the 10-year? I think
I see
I think it's down about 3/4.
403, we're up by about 8 basis points.
Yeah, so that's not working out. Or today it's working out, but it hasn't worked out for them. 10 years down in like almost any measure, quarter, month, year, 2 years. On the equity side, again, light positioning. And then in commodities, oil's been washed out. They really kind of squeezed that one. That was the only gainer that they probably had all year.
So Mark, what do you do in the second half? How does this work? You've had an equity rally that's confounded everybody. This was meant to be the year of the bond. Yeah, not so much. Mm-hmm. There's all kinds of things going on here that aren't meant to be happening. Does that continue in the second half? I'm hearing people talking about this being the euphoric phase of the equity market rally. How would you describe it?
I think euphoric is really a narrow course because, again, it's that grand seven of names. But back to the positioning in the hedge fund side, the hiring that's going on in hedge funds now is and has been on the industrial side because of the rate volatility. They think that prices are not going away. We're going to be higher for longer. So there's going to be, they're going to hire people who can get in between the cycles and the producer versus consumption cycles on.
Oh, interesting.
Yeah. As opposed to tech, because it's been all tech, it's been all macro, it's been all quant, is what we've been talking about.
Which is so interesting, Guy, because you and I were talking earlier about how you read the data, right? And from what Mark is saying, do you need to read the economic data? Or we kind of know where everything is going to go. There's going to be a downturn at some point, we don't know when. Now you have to look at other themes that's not that macroeconomic data read.
Yeah, and it's such a tough market to read, though. Mark talks about the gaps and where they exist, but you've seen a gap, and that gap has been so fleeting. If you're on a rugby field, the gap would open up, but it would be closed in a heartbeat, and you'd get hit, and you'd get hit hard. Mark, how open are the gaps? How long do they stay open? Where are the opportunities, and are those opportunities sustainable?
So I'm going to follow up on your rugby and say, that's first phase. I think the winners are going to be the type of firms that can play second and third phase rugby.
Oh, no.
So, I'm going to... He opened the door.
Guys, you just follow up.
Here we go.
And that's why that, scale is going to happen. Smaller hedge funds, have to be nimble. The hiring, as I said, of the industrial managers to come in because the top of the house thinks that we're going to be higher for longer, validated by what Japan just did on Monday by expanding and loosening that band a bit. So that battle for capital is happening. That battle for capital goes down to feeder stocks, and that's why the funds are making that investment.
So you're saying small firms. So it's the second, it's the third phase. If you're a big firm with an investment committee that doesn't meet that often and you're not that agile, this is not the market for you. Kind of talk me through what the implications are therefore for the bigger firms.
So for the bigger firms, they do have, I think some of the bigger firms are extremely well run. I mean, they've gone from a carburetor to a fuel injector to an electrical vehicle. They are just so calibrated on the liquidity in the market and how they can allocate leverage. So I think they're some of the ones that have done well mid-single digits this year.
If everyone, though, is doing the same thing now, are they going to be squeezed later? All of a sudden, it's going to be macro and AI in 8 months.
Yes, and that's back to what Guy was talking about with the gap, is that, I think what's the stat that something like 80% of gains in the S&P over 10, 20 years happen before open or after close. Mm-hmm. So you have to be positioned. And taking that a little step further, everyone is in the same trade, but the firms that can act quicker and are more fleet of foot and adroit from a technical standpoint and coordinated, they're going to win. I got one more rugby analogy, but we'll do it offline. I'm not going to continue that for you.
No, Guy would love it.
Yeah, go ahead, Guy.
Keep going. Yeah, I'm very happy for you to keep going. Keep going, Mark.
So the Argentine team, the Pumas, not the biggest team, they're known for their pack work because they actually breathe together in unison. I'll be finished in a second, Alex. And so what they do is they actually go in and they inhale and exhale in the same moment and push the team who's a good 150 pounds bigger off the mark. That's how the hedge funds are. They're so calibrated, they're able to do that. And if you don't have that degree of precision and you miss the moves, as you said, the gaps close, you're not going to be around.
And they're in our group, England's group, which I'm still concerned about. In fact, I think that group is much tougher than everybody gives everybody else credit for. Mark, in terms of the liquidity story, you mentioned liquidity just a moment ago. Talk me through fundamentals. We started off talking about fundamentals and the data. To what extent is what happening now just a liquidity driven rally that is still the legacy effect of the bank failures that we saw earlier on this year? The Fed's balance sheet is kind of round-tripped a little bit, but that extra liquidity, that extra kind of lump of liquidity that came into the market, to what extent is that responsible for what we're seeing at the moment?
I think it's a big deal, and I do think it's liquidity driven. You had a game of chicken between central banks globally, where between sovereigns globally, where the central banks were taking it off and the treasuries were adding. And then March is when we saw both Treasury adding and the Fed adding through the BTFP. I think I got that right. So to add to that, the BTFP, which is what was created in March so that all those banks that had 70 and 60 cent bonds could get collateral at 100 cents. It was an automatic upgrade. It's like going to the grocer, bringing back bad tomatoes, getting new ones. Mm-hmm. You do that all day. They're still doing it. That facility is getting more and more. It's at a peak as of last week. So we have not seen the end of bank pressure.
So, but there's the backstop, so there's that, so it's okay.
That's what's helping the markets. I think Treasury spending as a percent of GDP is at a almost all-time high, 24%.
Mm-hmm. So then, really quick before I let you go, when the Treasury issues a bunch more, then who buys that? So where does that liquidity go, and does that become a real hamstring? Hamstring? Does it hamstring the market?
It does get hamstrung, except they've gotten calibrated. The Fed and the Treasury are working together with the FDIC. This is a group effort, and when the Treasury issues, guess where it's coming from? It's coming from the repo facility that is already money out of the market. The T-bills are 20 to 50 basis points higher than the repo. So once they say, I want to sell more Treasury bills, the people who were getting, say, 4.90 or 5 at the repo facility say, I'll buy your T-bills. It's already out of the market. It's not a drain. We have about 1.7 billion left of that. When that's gone, you'll see the pain.
England, Japan, Argentina, Samoa, and Chile. I think that's actually quite a tough group, particularly if the Argentinians are all breathing at the same time. Mark, great to catch up. Really nice to see you. Thank you very much indeed. Mark Kodos, 3IQ, Head of Research. Still ahead, Uber reports its first ever operating profit thanks to really strong ridership demand. We're going to take you to San Francisco next. It is time for the startup. We'll deal with the details in just a moment. Take a look at the stock, though. That's maybe not the response you would have expected on today's numbers. Details to follow. This is Bloomberg.
It is 23 past 7 on the West Coast. We want to get to the startup. We cover the top tech stories from the gloomy Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Uber is down 5% or 4.5%. What happened here?
Yeah, I wonder if this is a kind of sell the news moment, right? Because all of the metrics were really strong. You know, record ridership, record driver availability and volume in the quarter, record gross bookings, a surprise operating profit on a GAAP basis, net income coming in at $394 million when the street expected a loss of $49.2 million. But go back to February. And in February, Uber forecasted adjusted EBITDA for 2024, next year, of $5 billion. And maybe there was some expectation that, well, if things are so good in the world of convenience, ride-hailing, and food delivery, why are they not raising those expectations for next year?
In terms of is there a macro read on the consumer here, Ed?
Yeah, I think, honestly, the story is really simple, that despite economic uncertainty or difficulty, call it what you will, in different markets, there's absolutely evidence based on all of Uber's metrics that people are willing to pay for the convenience of a ride hail or having food delivered. The kind of weaker spot was that freight continues to have a loss on an adjusted EBITDA basis, but freight is kind of out there. We're not really paying attention. You know, at least they did acknowledge on the call, and maybe this is downward pressure on the stock as well, that Lyft is being more competitive pricing-wise, and that they see a two-player market for some time. In other words, Uber's not going to completely all-out dominate. So we know they're being competitive on pricing, and maybe those pricing incentives help the consumer.
I was wondering, Ed, sort of what the next big shift is for Uber, right? Like the freight thing didn't work out, like you said. And I was like, what is this company going to become? Like, how is it going to adapt? And I wonder, is it just the self-driving stuff? Like, is that going to be the next iteration, and how long do we have to wait for that kind of catalyst?
I asked our audience, Twitter, Threads, LinkedIn, and many people responded with that question. You know, what is the next technological advance? Remember, Uber basically sold off its self-driving operations, or divested them. For you guys in New York or Guy in London, maybe not so, but here in San Francisco, jumping in a Waymo or a Cruise with no driver in the front seat is a reality. I've done it, I've written about that. So what happens long term, right? Are they still interested in operating their own fleet of vehicles? That's a question. And then what about the Everything app? You know, I don't want to give too much away because we're going to speak to the CEO, Dara Khosrowshahi, in Bloomberg Technology, but Uber is as close to an Everything app here in the US and Europe as anything else we see in Asia. So what else are they going to add to the platform, financial services wise, or other offerings that kind of make it more of an Everything app?
Yeah, it's interesting. They're talking about how some of the fintech stuff is helping out their drivers. They're talking about self-driving being 7 to 10 years away. That's a long time to wait for that kind of technology to really kick in. That's what Dara's talking about. Anyway, Ed, it's going to be a cracking interview. He's always great to talk to. Looking forward to it a little bit later on. Ed Ludlow talking to Dara Khosrowshahi. Bloomberg Technology up in around 90 minutes time. We're going to be talking retail next. Just